start.
Okay. Good evening, everyone. I'm your MOC for the day, CA Dipali Kocheta. Welcome to Pune ICI, our VCM on taxation of cooperative society. I welcome our dignitaries, our today's speakers, CA Sanjay Vanbhatte sir and CA Pranav Apte sir, Treasurer, Pune ICI. I invite CA Pranav sir to please give the welcome address.
Thank you, Dipali. Good evening, all. We welcome all on day 2 of Direct Tax Refresher course 22-23. Today's topic is taxation of cooperative societies, and we have the eminent faculty, CA Sanjay Vanbhatte sir, who will be enlightening us on various aspects of taxation of the cooperative societies. So taxation of cooperative societies basically is a very, what I can say, a very vast subject that way. And we are very much delighted that CS Sanjay sir has accepted our invitation and agreed for enlightening us on the various practical aspects and the intricacies of this particular topic. So we welcome Sanjay sir for today's webinar. And I hand over to CA Dipali for introduction of our today's esteemed guest. And this one.
Thank you, sir. So I would like to introduce today's speaker, CA Sanjay Vanbhatte sir. He's a BCom, FCA and DISA in ISA. He ranked first in the Shivaji University for BCom. He's a merit ranker in CA exams as well. 32nd rank for CA Inter, 36th rank for CA Final. He has also scored the 10th rank for ISA in September 2003. He's a CS Final as well. Sanjay sir is a chairman of Kolhapur branch. He was a chairman of Kolhapur branch in 2003 to 2004. He's a part-time lecturer for MBA students at Shah Institute of Business Education and Research for 22 years. He was a part-time lecturer for BCom at Vivekanand Shikshan Sanstha for 27 years. He is a speaker at various seminars and conferences on income tax. He's a co-opted member in the Committee of Direct Taxes with the Institute of Chartered Accountants of India, New Delhi, in the year 2021 to 22. I think we have a very apt and a learned speaker today, and very apt for today's topic. So I would like to invite CA Sanjay Vanbhatte sir to please continue.
Yeah, thank you, Deepali, and thank you, Mr. Pranav, for the nice words used for me. Shall I share my screen now with the PPT? Shall I share?
Yes, sir.
Yes.
Is my screen now visible?
Yes, sir.
Yes. Sir.
Shall I start now?
Sure.
Yeah. Okay. So the second day of Direct Tax Refresher course of Pune branch, I'm given the responsibility of handling the taxation of cooperative societies. So let us start with the taxation of cooperative societies. Particularly to start with, I must start with this phenomena of this year's financial proposals or indirect tax proposals in the Finance Bill 2023. Because a lot of thirst, a lot of impetus has been given to the cooperative sector in this budget. But those changes I'll be covering at the end of my deliberation. We will start with the basics. We'll understand the structures, the status and all that. Then I will take up the peculiar issues with respect to cooperative banking sector. Then I will take up some issues with respect to cooperative credit societies. And then finally, we will look at the changes which are proposed in the Finance Bill 2023 in the recent budget proposals. So let us start with this. We can see here status of the cooperative society. Registration of this cooperative societies, registration under the Cooperative Societies Act, Maharashtra State Cooperative Societies Act. But in section 231, which defines person, it does not include a separate category of cooperative society, and therefore cooperative status as such in terms of section 231 is AOP, and accordingly we required to file a return in ITR 5, just like which is a common form for AOP, BOI, and partnership form. So ITR 5 is the form which is applicable to cooperative societies. So this is with regard to status. As regard this tax structure, you can see a Finance Act prescribes separate tax structure for cooperative societies. Section 219 defines what is meant by cooperative society. Cooperative society registered under the Cooperative Societies Act or under the relevant state act. This is the present tax structure. First 10,000, 10%, thereafter next 10,000, 20%, and whatever is above 20,000 is 30%. So this is a separate slab structure, especially for the cooperative credit, so cooperative societies. And of course, there is education of 4% and surcharge of 10% if the income, taxable income, total income of the cooperative society is in excess of rupees 1 crore. Now, when we think of a cooperative society, we think of Section 80P. Section 80P gives various types of deductions to which are available for the cooperative societies, various types of cooperative societies or various types of activities which are engaged or which are carrying on different types of activities which are mentioned in Section 80P. Now, let us first read Section 80P 2A, in which you have the different types of deductions that are specified. Now, Section 80P 2A gives 100% deductions for whatever income that you have from these prescribed activities. Now, carrying on the business of banking or providing credit facilities to its members. Now, banking is highlighted essentially because now banking, this wording in 80P 2A1 remains the same. Carrying on the business of banking or providing credit facility to its member, this wording remains the same. But effective AY 1718, sorry, effective AY 2007-8, 80P 24 is a new section which has been introduced, and now 80P 24 blocks the deduction of 80P 2A1 for the banks, cooperative banks. These deductions will not be available. That is specific section 80P 24, which forbids the deduction of Section 80P 2A1 to the cooperative banks. Cottage industry or deduction allowable to the industry, then the marketing of agricultural produce grown by its own members. Then you have the purchase of agricultural implements, seeds, livestock, or other articles intended for agriculture for the purpose of supplying them to its member. The processing without the aid of power of the agricultural produce of its members, the collective disposal of labor to its member, or fishing or allied activities. This is the encompass of 80P 2A1. So 80P 2A, so not 80P 2A1, it is 80P 2A, which gives 100% deduction in respect of the income earned on the activities covered in all these 80P 2A1 to 80P 2A7. Now we go to 80P 2. Now in 80P 2, you have this B, in which in the case of a cooperative society being a primary society engaged in supplying milk, oilseeds, fruits, or vegetable raised or grown by its members to a federal society. Means now we have local primary milk cooperative credit society, milk collecting societies, primary milk societies, which collect milk at the village level from actual milk producers, and that milk which is collected in the village is supplied to a federal cooperative society, taluka level or district level cooperative society. Now, such business of collecting milk from the actual producer of the milk and then supplying to the federal cooperative society is what is sought to be exempt, either to a federal cooperative society or to government or to a local authority. This supply can be by the primary milk society to the federal society, or to the central government, or to the government, or to the local authority. Now, 80P 2C is with respect to a general clause as to if you are not engaged in any of the activities which are mentioned in 80P 2A1 and 80P 2B just now we saw, then you get this general deduction. That general deduction is for consumer cooperative society, it is 1 lakh rupees, and for others it is 50,000 rupees. Now here I would like to invite your attention to the decision of the Supreme Court in Mavilai Cooperative Credit Society, where Supreme Court in no uncertain terms has held that if a society is claiming deduction under section ATP2C, that is the residual clause of rupees 50,000. If you are a consumer cooperative society, you don't get a deduction under ATP2A1, sorry, ATP2A or ATP2B, you only deduction under ATP2C. But some societies, they going for this temptation of claiming the deduction under section ATP2A1, 2A, ATP2B at times, and sometimes for example, some societies, say for cooperative credit society, Pata Samstha in our area, they claim deduction with respect to their business income under section ATP2A1. But for rental income, they go for ATP2C. Because rental income, they don't offer as income from business, cannot be offered also as income from business. Then in respect of that rental income, they claim deduction under section ATP2C, that 50,000 rupees residual clause. This has become very dangerous now after the decision of the Supreme Court in Mavilavi Cooperative Credit Society, because Supreme Court has categorically said that if a society claims deduction under section ATP2C, that means it is engaged in other activities other than those mentioned in ATP2A and ATP2B, and therefore such society, if claims deduction under section ATP2C, will not be eligible to claim deduction under section ATP2A or ATP2B. So be very careful while claiming the deduction under ATP2C rupees 50,000 residual clause. You will possibly land in problem of losing the deduction, which is far bigger than this ATP2C rupees 50,000, with particularly with respect to societies like cooperative credit societies, cooperative primary milk societies. Those are enjoying deduction with respect to their business income in full, and that exemption, that deduction is far bigger than this rupees 50,000 residual clause ATP2C. So you have to be very clear on this understanding. You never get tempted to claim the deduction of this 50,000 rupees, because that will prejudice your claim of ATP2, ATP2A and ATP2B also. Then next is ATP2D, that is interest and dividend from cooperative other cooperative societies. Now this is a highly litigated area from after the deduction of after the decision of Karnataka High Court in Todgar's cooperative society, that I'm going to discuss separately, so I will not spend more time here. But ATP2D, any income received by cooperative society in the form of interest or dividend from other cooperative societies, then that is eligible for deduction under section ATP2D without any restriction. Whatever interest, whatever dividend that one receives, a cooperative society receives from any other cooperative society, that is eligible for deduction under section ATP2D, including from a cooperative bank. That we will see, discuss little later as to what happens when it is the interest from or dividend from a cooperative bank. ATP2E is the last one, and income from letting of godowns or warehouses for storage, processing or facilitating the marketing commodities. Income from cold storage is also eligible under this section. This is income from house property, interest security, if gross total income does not exceed 20,000 rupees, or it is restricted to 20,000. Other than housing, transport, this is not available to housing, transport, manufacturing, unworked consumer society. This ATP2 is not available. It is available to cooperative society other than this. And if it is you have an income from letting of godowns or warehouses for storage, etc., then the ceiling is 20,000 rupees. Now, 115 BAD is a new section which was introduced by the Finance Act 2020. You have 115 BAA, 115 BAA, which is for the companies which provides a concessional tax rate of 22%, where the effective tax rate with surcharge and education comes to 25.168%. So this section which came in a little later because 115 BAA came in by Taxation and Other Laws Amendment Act 2019 and it was available from AY 2021. But this came little later and it was available for 21-22 and is available or is applicable only to the cooperative societies who are not eligible for deduction under section 80P. Because one should remember that when you opt for 115 BAD, you do not get any deduction under chapter 6A. So 80P deduction is one of the deductions on the income side under chapter 6A. So if you are a society which is eligible, say for Pata Samstha, if you are a cooperative credit society, Pata Samstha, you are eligible for deduction under section 80P, then you should never opt for 115 BAD. Because 115 you opt for it, then you lose 80P deduction, you are straight away in 22%. But if you are a cooperative bank, then you are not eligible for deduction under section 80P because of 80P 24, which came from AY 7-8. Then you must go for 115 BAD because if you do not choose 115 BAD, then your income is taxable at 30%, as we saw in the second slide. So 30% versus 22%. Or rather 25.168% versus 31.2% is the gap between the tax rates. And because of this gap between the tax rates, it would always be advisable for those types of cooperative societies which do not have specific deduction under section 80P should go for 115 BAD, just like the companies should opt for 115 BAA. Here, the cooperative societies also should opt for 115 BAD. So this was I was talking that the effect reduced tax rate of 22% with effect from assessment year 21-22. It is an optional. It is applicable to resident cooperative society. It is optional. This thing choice. You can choose it. You need not choose it. It's not forced. Then applicable surcharge and cess, that's what I said, the effective tax rate 22% becomes 25.168% because 22 plus 10%, 24.20%, on that 4%, 25.168%. And just now I discussed the issue of cooperative banks versus cooperative societies. Now, cooperative banks, I told you, they are not eligible for deduction under section 80P, but cooperative societies, cooperative credit societies, they are eligible for deduction under section 80P. So for cooperative banks, since 80P is not available, they should go for concessional rate under 115 BAD. Cooperative credit societies, they are eligible for deduction under section 80P. They should never go for 115 BAD. So this has to be carefully done at the time of filing every return. There are certain conditions attached to the section 115 BAD. Now, what are these conditions? These conditions, option must be exercised on or before the due date of filing the return under section 139(1) by filing form 10F. This option can be chosen at the time of any return for which year you want to choose or opt for 115 BAD. For that years, before filing of the return of that years, you have to file this form 10IF. Okay, but the problem is that once you choose 115 BAD, then there is no coming back. You cannot withdraw because then you are forced to follow that 115 BAD proposition, and that is the difficulty with respect to that cooperative bank versus cooperative credit society. Because if by any mistake you choose 115 BAD for a cooperative credit society like society, then you permanently lose 80P deduction, and therefore you have to be very careful. Next. You will not get various types of deductions, and those deductions are mentioned in the section. You will not get the additional depreciation under section 32(1) Roman small a, that is 20% on the new plant and machinery. You will not get 35D, 33AB. All those deductions you will not get. You will not get any chapter 6A deductions except for 3. Those I will discuss. You will not get set up of brought forward losses attributable to such prescribed deductions. Then corresponding brought forward adjustment. That means this is a slightly intricate issue. Corresponding adjustment to brought forward depreciation that was applicable to AY 21-22 only. Thereafter, it is not applicable. So therefore, I will not discuss. Claim of additional depreciation on plant and machinery to be foregone. You cannot do this. Surcharge without any threshold will apply. And MAT provisions, or rather here, AMT, alternate minimum tax, AMT provisions 115 JC and JD will not be applicable. So therefore, if you are enjoying or if you have carry forward position of MAT, AMT, then under section 115 JD, then you have to actually calculate which is beneficial for me. Typically, unless and until the carry forward position of AMT is exhausted in full, one should not opt for 115 BAD, but the choice would depend upon the calculation for each of the year, and one has to take a calculated call so far as choosing the 115 BAD. So this was the tax structure deductions basically available and overall income pass, general overall income pass of the cooperative societies. Now I'm taking you to issues with relating to urban cooperative banks. This is the second aspect of today's deliberation. Now look here, as I have been telling you, effective 1st April 2007, that is AY 2007-8, there is a new insertion of a new section, that is ATP 2 which says that the provisions of this section shall not, this section means ATP section, the provisions of this section shall not apply in relation to any cooperative bank other than a primary agricultural credit society or a primary cooperative agriculture and rural development bank. Now you can understand why did they keep the word banking in this, why did they keep the word banking here? Because in case of primary agricultural cooperative and rural development bank, they still want to continue with this deduction. So therefore the word banking has been kept here and ATP 2.4 is introduced here. And this ATP 2.4 now says that the provisions of section ATP will not apply to cooperative banks other than these two types of cooperative societies and a bank. Therefore, now all cooperative banks are now at par with the nationalized and private banks as far as income tax is concerned. Now, deductions which are specific to cooperative banks, I'm going to discuss now one by one. First is deductions under 36(1)(7)(a), that is BDDR deduction. The second is special reserve under section 36(1)(8). Third is interest on NP under section 43D. And finally, investment and deductions and other deductions. So in these 5 aspects, we will look at the deductions that are available to cooperative banks. Let us first start with 36(1)(7)(a). Now 36(1)(7)(a) is a deduction with respect to provision made by a cooperative bank in its profit and loss account for bad and doubtful debts. So it is basically bad and doubtful debts reserve what we are talking about. And this deduction is to be restricted to the aggregate of the 2 following amounts. That is, one is 8.5% of the total income computed before allowing any deduction under this section and chapter 6A. That means you have to deduct all other items. You have to calculate your business income, but that total income will be before allowing any deduction under 36(1)(7)(a) and chapter 6A, and 10% of the aggregate average rural advances. Now the bank is required to make provision in profit and loss account for claiming the deduction under this section. There have been various litigation cases with respect to this second aspect, whether the bank is actually required to make provision in the profit and loss account for claiming deduction under this section. And what I mean to say is that, suppose I have substantial spread of my business as a cooperative bank in a rural area. Then what happens is that 10% of the aggregate average rural advances, I have to calculate the average of monthly average of 12 monthly average, and accordingly monthly average means opening balance and closing balance at the end of the month, uska average, and then such average for 12 months, and then average of those 12 months, and thereafter 10% of it. That is how the mechanism prescribed. So 10% of the average rural advances, this amount can be substantially high in respect of a cooperative bank which has spread in rural area. Now suppose, for example, such 10%, suppose I have advances given of say 50 crore rupees, which are in the rural areas, my rural branches have given these advances, 10% of this comes to 5 crore rupees. But as per IRAC norms, income recognition and asset classification norms of the Reserve Bank of India. Suppose I am required to make provision of just 50 lakh rupees because I have accumulated provision of BDDR which has been made by me in earlier years, and this year's incremental provision is just 50 lakh rupees which I have to make by way of debit to the profit and loss account as per IRAC norms of the Reserve Bank of India. Now here we have a scenario that I have debited only 50 lakh rupees, but the figure of 10% of the aggregate of average rural advances, my rural advances are 50 crore rupees and 10% of this comes to 5 crore rupees. Now, what do I get the deduction for? Do I get the deduction for 5 crore rupees, or my deduction under section 36(1)(7)(a) would be restricted to only 50 lakh rupees? Now, this litigation has been there since AY 2007-8, since the year the cooperative banks lost the umbrella of deduction under section 80P. Starting with Mahalakshmi Cooperative Bank's case from Kolhapur, the Pune IIT has been taking consistent stand that the deduction has to be restricted to the extent of provision made to the profit and loss account, that is 50 lakh rupees, and it cannot be extended to 5 crore rupees. The dispute has arisen only because of the starting words of this section 36(1)(7)(a). The starting words of that section 36(1)(7)(a) are like this, that in respect of any provision made by the cooperative bank in respect of. So in respect of any provision made, it talks about. This wording is substantially and clearly different from a deduction under section 36(1)(8). 36(1)(8) and 36(1)(7)(a), when one compares the words used in these two different sections, then one can clearly come to a situation that 36(1)(8) has to be strictly restricted to 20% of the income subject to the actual provision made, but similar words are not there in 36(1)(7)(a), and therefore actually the dispute arose. People have taken a view on that on this clause, that in respect of any provision made means I can make a provision of 1 rupee, but I can claim a deduction of 5 crore rupees if 10% of aggregate average rural allowance comes to 10%, or aggregate of this 1 and 2, 8.5%, 7.5% earlier, but now 8.5% and 10% of the aggregate average rural allowances say comes to 5 crore rupees, then I can claim the deduction of 5 crore rupees, was the stand that was taken initially by many banks. But Pune IIT is consistent on this. There has been so far no decision of the Bombay High Court or any jurisdictional High Court, but there is one decision of Delhi High Court. I don't know whether I'm having this. Yes. Yeah, this is what I was discussing, Mahalakshmi Cooperative Bank. This is the Delhi High Court decision. In the case of Prathama Bank, 88 Taxman 572 has held the issue in favor of the banks. What I mean to say is that this decision is available with respect to, in our example, 50 lakhs versus 5 crore rupees. Delhi High Court in Prathama Bank says that yes, 5 crore you can claim, but Pune IIT, so far as Mahalakshmi Bank and thereafter following various judgments, now the scenario is different. But after the Prathama Bank, there, at least to my knowledge, there is no such decision by the Pune IIT which is in favor of the cooperative banks. But the matter stands as of today is something like this, that Pune IIT is taking unfavorable view to the assessees, and Delhi High Court in Prathama Bank taking a positive view in favor of the assessees, allowing the larger amount of deduction irrespective of the actual provision made. Yes. Now, next question is the deduction allowable only for provision in respect of rural advances? Now, we are talking of that 8.5%. 8.5% of the total income. Now, 8.5% is not regarding only with respect to provision debited to profit and loss account with respect to only rural advances. That is not the case. Say, for example, in our example, 50 lakh rupees is that amount debited to the profit and loss account. Out of this 50 lakh rupees, and 50 lakh is 8.5% of my total income. But out of this 50 lakh rupees, 40 lakh is rural advances, 10 lakh is urban advances. So will I be restricted? Will I be getting restricted deduction of only 40 lakh rupees? The answer is no, because 8.5% of total income does not make any distinction as to provision with rural advances or provision with urban advances. So you will get the deduction for the entire advances. That is the provision, and that has been clearly held by Pune IIT in Bhagini Nivedita. Next issue on this is, can the provision of BDDR be made through profit and loss account appropriation account? Means below the line. If I make any provision below the line, not as a charge in the profit and loss account, will I be set to be complying with the requirement of 3617A of creating necessary provision through profit and loss account? Pune ITIT and Ganesh Bank of Vanbhatte has held that yes, if the provision is made even through an appropriation, still that will meet the requirement of 3617A and one will be eligible to get the deduction of this. And the last technical issue is something like this, that can the requirement of section be technically met by crediting excess BDR to profit and loss account and simultaneously debiting the current year's provision to profit and loss account? What I mean to say that, suppose in my example, I am eligible for 5 crore rupees as a deduction. What I mean is that 8.5% of my total income plus 10% of the aggregate average rural advances. In dono ka total, if it is coming to say 5 crore rupees. But as per Reserve Bank of India's IRAC norms, I am required to make provision only of 50 lakh rupees. This is because I had already created substantial provision in earlier years. So incremental provision as per Reserve Bank of India's IRAC norms, I am required to make only 50 lakh rupees. So I have debited 50 lakhs to my profit and loss account. But to meet the requirement of 3617A, suppose I do like this, that I will credit my profit and loss account by 4 crore 50 lakh rupees, because that is additional provision, and I debit 5 crore rupees to my profit and loss account. So you understand me? 5 crore rupees debited to the profit and loss account and 4.5 crores credited to the profit and loss account. So net debit to the profit and loss account is only 50 lakh rupees. So instead of debiting this net amount of 50 lakh rupees, I am debiting 5 crore rupees and crediting 4.5 crore rupees. Now the question is, yes, 5 crore rupees you have debited to profit and loss account, you are eligible for this deduction. But what happens to 4.5 crore rupees, because I am reversing that provision which I made in earlier years, and will that be taxable under section 41(1) or under section 41? Because it is a reversal of excess BDR. What I am doing is I am debiting profit and loss account with 5 crore rupees and I am crediting the profit and loss account with 4.5 crore rupees. So effectively I am debiting the profit and loss account net by 50 lakh rupees. But instead of doing that, just to meet the requirement of 3617A provision by debit to the profit and loss account, I am debiting by 5 crore rupees. But my earlier years excess provision 4.5 crore rupees, I am reversing by crediting it to the profit and loss account. So 5 crore rupees, I will be allowed deduction because of 3617A. I am meeting all the requirements. But what about the taxability of the reversal of this 4.5 crore rupees? Will it be taxable under section 41(1)? So that I am trying to distinguish, or rather I am trying to elaborate, because not distinguish, but I am trying to elaborate. And if one takes a very aggressive stand on this, which I am now trying to explain before you, which if one takes a very aggressive stand, is still not interested, and at least I have not come across this type of tax planning or some kind of decision on this, but just a thought for as a brain teaser. See, when I reverse 4.5 crore rupees by way of credit to profit and loss account, what am I doing? Whatever provision I made in earlier years, of course, I have taken deduction of that, because whenever I made a provision by debit to profit and loss account, I made a provision of that, and I have claimed the deduction under 3617A in those years. Now that I am reversing. So whether that reversal, does it get caught in any of the sections of 41(1)? Now let's see. Section 41(1) speaks of taxability of any loss, expenditure, or a trading liability, deduction of which is taken earlier. Now whether this reversal of a provision of excess BDDR 4.5 crores in our example, is it a loss? Is it an expenditure? Is it a trading liability, deduction of which I have taken earlier? In fact, is strictly speaking, it doesn't fit into the encompass of any of these three words. It's not a loss, it's not an expenditure, it's neither a trading liability. It was just a provision allowed to me under section 3617E because of this specific provision I was given this deduction. So therefore, in this aggressive stand, if one wants to take, one can argue that it doesn't fit into any loss, expenditure, or trading liability. To substantiate this further, going with the very intent of section 41, you can see that you have section 41(4), which specifically tax bad debts recovery, which is allowed to you deduction under section 3617. And after the insertion of section 3618 with regard to deduction of special reserve, there is section 41(4)(a), which brings to tax special reserve when there is breach of certain conditions. So you have section 41 subsection 4 specific for taxing bad debts recovery. You have section 41(4)(a) specific for taxing special reserve, deduction of which you got under section 3618 when there is a breach of any condition. But there is no parallel section for 3617E. You have 3617, you have 3618, but not for 3617A. Had the intention of the law to tax such reversal also, then there would have been a parallel section or rather subsection in 41(4), specifically because reversal of bad debts provision doesn't get into the loss, expenditure, or trading liability phraseology. This is one of the very aggressive stand one can take, and that is how one can try to be aggressive in tax planning. Of course, this is just a great thought I'm presenting before you. Nowhere I could have, I have seen this having been tested on any legal forum, but that's how I'm just putting this before you. Deductibility of provision of standard asset is one of the issues. See, BDDR is a reserve for bad and doubtful debts. So any provision, banks are required to make as per IRAC norms provision even against the standard assets 0.25% and 0.40%. But that part of the provision which is debited to the profit and loss account, it is a provision against the standard assets. So that is not allowed as deduction under section 3617A. Then there is section 3625, which one must bear while claiming deduction under section 3617 and 3617A. It says that no deduction for bad debts written up is allowed unless the bad debt amount is first debited to BDDR. That means, suppose you have BDDR reserve of 20 rupees and you have bad debt of 15 rupees, then you cannot claim the deduction of that 15 rupees because you have to debit this 15 rupees as a bad debt to bad debt reserve, and still there is a 5 rupees bad debt reserve left. So you don't get a deduction of 3617. But suppose you have a reserve of bad debts reserve of 20 rupees and now your bad debts actually are 30 rupees. So 30 rupees debited to 20 rupees, excess is 10 rupees, and only 10 rupees is what you get. That is the content of the provisions of section 3625. Right? And that is how one has to implement and apply 3625. Now here is I'm trying to give an example as to the applicability of section 3617 versus 3625. Now here you can see there is a bad debts for opening BDDR provision of 76 lakhs. Then during the year I have written on 1412 lakhs as bad debts. So deduction I have claimed of 13 crore 36 lakhs. And at the end of the year, I made a provision of 1 crore 36 lakhs. So to repeat again, opening provision 76 lakhs, bad debts during the year 14 crore 12 lakh rupees. So I claimed a deduction of 13.36 lakhs because 14.12 minus 76 as per 3625. So I claimed reduction of bad debts under section 3617 of 13.36 crores. But at the end of the year, I have again made a provision for BDDR of 1.36 crores. Now, in whether this 1.36 crore is to be again also reduced and I will be allowed deduction of 12 crore rupees, or I will be allowed deduction of 13.36 crores. So you can refer to para 2 small Roman 2 of circular number 17 of 2008. Circular number 17 of 2008 is a very classical circular dealing exclusively and exhaustively with respect to the taxation issues of the cooperative banks, which I am discussing one of them, 36.178, 36.18, and bad dates and investment and all those things they discusses in length, and it gives a good amount of guidance as to the how the deductions are will be allowed in case of cooperative bank. So one can beneficially refer circular number 17 of 2008. Now here, going by the provisions of that circular, 1.36 crores, the provision which I make at the end of the year is not required to be deducted. I will be allowed deduction of 13.36 crores under section 3617, meaning thereby a takeaway from this slide is that against the bad debt claim under section 3617, I just have to reduce the opening balance in the BDDR. I don't have to take into account the provision made by me at the end of the year, which is a closing provision. That is the takeaway from this slide. Now, having discussed in detail 3617A, now I'm taking you to 3618. Now, 3618 is like a typical specific deduction with respect to cooperative banks. In fact, it is for all banks. So therefore, for the cooperative banks also, it gives deduction of 20% of the profits of eligible business. You have to create a special reserve of the equivalent amount. And eligible business means long-term finance, 5 years and above, finance for any of the following categories or sectors: industrial or agriculture development, development of infrastructure facilities, and development of housing. And the last condition is special reserve cannot exceed twice of the paid up capital and general reserve. So if it exceeds, then you stop getting deduction under section 3618. So 20% of the eligible business is long-term finance to the specified sectors, and upper ceiling is special reserve up to twice of the paid up capital and general reserve. This is the typicalness of 20%, this 3618. Recently, there was a decision of the Cochin ITT, which is very interesting decision. Now, development of housing. The decision is on development of housing. What happened in this case is that this South Indian Bank claimed a deduction under section 3618. It met all other requirement of this section. They were in giving housing finance to various individuals, just like any other HDFC and all those give. So they have been giving housing finance, and this was considered by South Indian Bank as eligible business under section 3618. A required special reserve was created by debiting a necessary amount to the profit and loss account, and accordingly deduction was claimed of 20% of the profits of such eligible business. The question came up before the ITAT. Department's argument was that the housing finance which is given by South Indian Bank to various individual for purchasing individual flat or construction of house is not for development of housing. It cannot be considered to be a finance for development of housing. And South Indian Bank, in the case of South Indian Bank, Cochin ITAT has held in favor of the department. It has held in favor of the revenue, saying that giving individual finance for purchase of a flat or construction of a single house to an individual does not amount to the finance for development of housing. The finance for development of housing is something which is given by the bank to other bank, or a special corporation established for the development of housing, which refinances the housing finance given by other banks like South Indian banks. So if you are a refinancing bank and giving established specifically for housing development, and you are refinancing this to say banks like South Indian Bank, only in such cases your business will fall in the category of development of housing. Otherwise, individual finance by a bank to individual flat buyer to a constructor of a house will not amount to a business of development of housing. Thereafter, there has not been a decision, but one really has a doubt whether this decision is correct or otherwise, with due respect to the legal form. But a debate has to take place, because in my personal opinion, I hold a view that individual finance given to a flat buyer is also for the development of housing, because only because of these financing facilities available, people are people tend to buy houses, and that is how there is a development of the sector housing, and therefore it's in a broad sense the deduction ought to have been allowed. Section 43D, now there is nothing much left here, because 43 had been made applicable even to cooperative banks. Previously it was available only to the scheduled banks and nationalized bank, but now with the amendment from AY 1819, it has been made applicable to even 43D. 43D is specific accrual system of accounting, whether interest on NPA, non-performing asset, has it to be offered to tax as per the accrual system of accounting, irrespective of the fact that you are not allowed to recognize that income in your profit and loss account as per the RBI IRAC norms. See, look here, it came in 2018 from AY 1819. So what would have been the status between 2007-8 to AY 2017-18? There was a problem, but the decision came in favor of the bank that still, irrespective of there is no specific provision or there is no specific mention of cooperative banks in section 43D. Various high courts, including Bombay High Court, held that since when the basic principle itself in laws, there is no real income, and applying the real income theory, the courts and ITDs were holding that irrespective of there being no mention in section 43 of cooperative banks, still the income would not be taxable in respect of NPA on the basis of accrual system. Now the dispute is altogether over, and OIR, overdue interest reserve, is what you see in the balance sheet on both sides, a contra item in the balance sheet of any bank. So is with the cooperative banks. So AOs used to tax the incremental amount, last year's OIR and this year's OIR. Difference between the two is the accrued income on the NPS, which you are not allowed to recognize as income, and that is why it used to appear in the balance sheet as a contra item. But now that is no more, and therefore 43D is clearly applicable to even cooperative banks. You have to recognize the income in respect of interest on NP advances on realization basis, going with the IRAC system of the Reserve Bank of India, simple, plain. And along with this amendment to section 43D, there was simultaneous amendment, almost simultaneous amendment in section 43B, where interest payable to cooperative banks, non-scheduled cooperative bank, was also brought into the amendment of section 43B, where the deduction was to be allowed only on the actual payment of the interest or interest paid till the due date of filing the return, right? So that is what this thing. Investment by banks and income tax. These are the scenarios. Banks are holding investment in three categories: HTM category, that is held till maturity, then AFS category, that is available for sale, and HFT category, that is held for trading. Now you understand this. HTM category, that is held till maturity, these are typically long-term assets, and there is a premium required to be paid depending upon the market of this securities traded and held by the banks, that you may have to pay the premium on acquiring the securities which you are required to hold as a SLR or SLR requirement. Now, if you have paid any premium, then such premium is to be amortized as per RBI norms. Such premium is to be amortized over an unexpired period of that security, and accordingly it is to be debited to the profit and loss. That equal installment over a period of unexpired period of the security has to be debited to the profit and loss account, and then amortize it. Now this amortization is allowed as a deduction as per Bombay High Court in HDFC Bank, and subsequently followed by many courts. So this amortization of premium on securities is allowable with respect to held till maturity. And even para 7 of circular 17 of 2008 allows this deduction amortization. So far as categories of available for sale, AFS and HFT, now these are basically current investments, and their valuation has to be made in the balance sheet based on the values, market values prevailing as on the date of your balance sheet as on 31st March. So you value as these investment categories of investment. At the end of the year, any increase or decrease in that is to be offered to tax or charged to profit and loss account. You accordingly get it. And so far as the interest for pre-acquisition period is concerned, that deduction is allowed to you, Vijay Bank versus CIT 187 ITR, and that is being allowed to you as deduction as per circular of 17 of 2008 para 2.6, there is no problem. So this issue stands settled so far as the investment. Then there are other issues with respect to the business and taxability of unclaimed dividends. So far as unclaimed dividends are concerned, since the dividends they don't get taxable under section 41(1), because you have not taken the deduction of dividends. It doesn't even taxable under section 56(2) as per the this thing. Because it is out of, basically it is a distributed out of the distributed income, distributable income, and therefore not taxable. Penal interest, even if credited to reserve fund, still it is an income, it's liable to tax. Then building fund. Now building fund can be considered to be a capital asset, because building fund is something which some banks collect as a deduction while giving the loan, disbursing the loan, and therefore sometimes people tend to make it as a capital asset and do not offer to tax. But after the advent of section 56 to 10, receipt of money without consideration, I'm doubtful whether this can be considered to be non-taxable. I hold a view that even if it is a capital asset, still it gets covered under section 56 to 10, and therefore it would be taxable under that section, if not as a business income. Section 14A, you can see that I have struck up the entire words only because the banks nowadays hold hardly any securities which are exempt. Previously, there used to be a division from mutual fund investment and all those things. Then, since it was from the mixed funds, applicability of section 14A was under the litigation and various decision. But that confusion hardly is now relevant, only because these days banks are hardly having any exempt investment as such, and therefore I'm not discussing much on 14A. And the last thing about this is whether section 48 2B applies to cooperative banks and cooperative society. Bombay High Court in this decision 301 ITR 191 has stated that section 48 2B as such does not have any application to cooperative society, and therefore one need not make any reporting even the tax audit report with respect to this provision if your audit is a cooperative society. Excess cash received, if it is transferred to reserve fund, but within those period of 3 years, because anybody can claim, make a claim for excess cash received within these 3 years, then definitely that becomes immense liability. But after 3 years or after that mandatory period of claim gets expired, and thereafter it becomes non-claimable, then if it still remains with you, then it is taxable. If it is transferred to a special fund created, then it may not be taxable. Provision for audit fees 43B, it does not apply. And loss and merger to be considered an intangible asset. In Cosmos Bank's case, Pune IDT, 25% deduction available. That was the decision available. Taking you to the recent amendments, 206, 194A and 194N TDS section. Again, with respect to cooperative banks, I'm going to discuss. Let us discuss those issues first. Section 206A, you have to, it makes it mandatory for all the cooperative banks to file Form 26QA, filing a quarterly return of interest below threshold of 10,000 rupees by banks, by cooperatives by a prescribed mode. So see, interest paid about 10,000 rupees, it is basically coming in your 26Q because it is subjected to TDS. If it is, even if it is not subjected to TDS because of submission of Form 15G or H, still a reporting of that non-deduction still has to be in Form 26Q. But any interest paid below the threshold of 10,000 rupees, even if it is the interest on saving banks, then still the banks are required to make a reporting of it under section 26QA, and a separate return, under section 206A, a separate return 26QA is required to be filed by the cooperative banks. 194EN is something new, recently came up, and you know that TDS of 2% on cash withdrawal exceeding rupees 1 crore is required to be made, and here I'm discussing this issue with respect to a deductor, because this deductors have to be cooperative banks or cooperative society, banks, cooperative society engaged in carrying on the business of banking, and post office. So basically we are talking of all banks and a post office. And whenever there is a withdrawal from the account by any person, the TDS of 2% applies, and that this 2% is subject to from any account maintained by the recipient with it, and not applicable for payment made to government, banking company, cooperative. So one bank withdrawing from other bank, or one cooperative bank withdrawing from another other cooperative bank or other national bank. And of course, white label automated tailor machine operator of a bank. That means they are your ATM maintainer, ATM people who maintain ATMs and fill in the cash in the ATM. That is white label automated tailor machine operators. So those people are specifically exempted, and any other person which is notified by the government with respect to the exemption, those people get out of this cash withdrawal TDS under section 194N. But as a banker, one has to be very careful as a deductor as to the application of this section 194N, because this has cast a very substantially big responsibility on the cooperative banks to comply with the requirement of section 194N with regard to TDS of 2% on this. Now here we come to the next aspect of this 194N, which has this slabs. Now a new provision has been inserted effective by the Finance Act 2020, where this 1 crore threshold has been reduced to rupees 20 lakh rupees. Now this reduction of 20 lakh rupees, something like this. Now you have two slabs. In case of a non-filer, the slab is not 1 crore rupees. It doesn't start with 1 crore rupees. It starts with 20 lakh rupees. So if your cash withdrawal from any or all accounts put together in aggregate, if it is between 20 lakhs and 1 crore, then 2%. And if it exceeds 1 crore rupees, it is 5%. And what is meant by non-filer? A non-filer is a person who has not filed his returns in any of the last previous 3 years. If you're talking of, say, financial year 22, 22, 23, then you have to see the earlier 3 years. And in all of these earlier 3 years, if he has not filed his income tax return within the time limit of section 139(1), not 139(4) or not 139(8)A, that is updated return, not. It is 139(1), original time limit. If one has failed to file the returns in all the 3 years, that means if he has filed the return even in 1 year, still he doesn't become non-filer. Non-filer is default for all the 3 years. Then only he attracts the reduced slab of 20 lakhs to 1 crore rupees, 2%, and above 1 crore, it is 5%. So that is what is meant by a non-filer. Basically, filing the return, or a person has filed the return or not filed the return, how does one check? There is an online functionality available on the e-filing portal. You can put the PAN, give your mobile number, and an OTP is given, is received by you. And individually check, you can check a PAN as to the liability, whether as to the slab rate applicable to it is 20 lakh rupees or 1 crore rupees. And there is also a functionality available to check the status on bulk basis. So accordingly, one can check this. Particularly bankers, they are required to check with respect to all their accounts at the beginning of the year. Once they check this at the beginning of the year, then accordingly their masters have to be accordingly updated. And after updating this master, these slabs have to be put in the masters, and whenever the master alerts you about the withdrawal about 20 lakh rupees or 1 crore rupees, as the case may be, the TDS has to take place and the master has to be accordingly designed. So it's a very critical issue with respect to the software management, and one has to take into account that. Now the next issue is 194A3. Regarding this, I can tell the amendment of this year's budget here itself, because that slide is coming a little later. Now, with respect to a cooperative society, as a deductee, not a deductor, as a deductor, and then is a person withdrawing the cash. So a cooperative society withdraws cash, then the limit of 1 crore will stand substituted by 3 crore rupees. That means 20 lakhs to 3 crore rupees and 3 crore and above. That is how it is. And if you are a regular filer, or if you are not a non-filer, then TDS will start only from 1 crore rupees, 2%. And if you are a non-filer cooperative society, then 2% will be from 20 lakhs to 3 crore rupees, and 5% will be above rupees 3 crore rupees. So 1 crore gets substituted by 3 crore rupees for cooperative society as a deductee, as a person withdrawing cash from a bank cooperative bank or a post office. So in all these cases, 1 crore stands substituted by 3 crore rupees by this is the proposal. It may become an act, and accordingly enhanced limit of 3 crore rupees will apply to cooperative societies effective 1st April 2023. Now here I am taking you to 194A3. Now 194A3 gives 194A is TDS from interest paid. Now 194A3 gives exemptions or specifies the interest which are not liable to TDS. For example, interest paid by a cooperative bank on the saving account is not liable to TDS. Interest paid by a partnership firm to the partners on their capital account, loan account, etc. is not liable to TDS. All these exceptions or exemptions from TDS from 194A, they are given in 194A3. Now 194A3 Roman 3 gives exemption: interest paid to any banking company or any cooperative society engaged in carrying on the business of banking business. Interest paid to any cooperative society engaged in carrying on the business of banking means a person paying. Suppose I have taken loan from cooperative bank, then I am paying interest. I am auditable and I am paying interest on loan to the cooperative bank. Then I am not required to do the TDS. This is what 194A3 small Roman 3. Now coming to 194A35, interest paid by a cooperative society other than a cooperative bank to its member. So interest paid by a cooperative bank to its member or non-member, it is liable to TDS. But interest paid by cooperative society other than a cooperative bank to its member, interest paid by cooperative society like cooperative credit society, cooperative primary milk society, cooperative sugar factory, cooperative spinning mill, cooperative industrial estate, these cooperative types of societies, if they pay interest to their members, or such cooperative societies pay interest to another cooperative society, then it is exempt. Means interest paid by a cooperative society to any other cooperative society, and interest paid by a cooperative society other than a cooperative bank to its member is exempt. Now 194A3 was thereafter subject to change, and this exemption under 194.3 3 and 5 in case of a payer deductor has been withdrawn where the gross receipts in the previous year exceed 50 crore rupees. Say for example, a cooperative sugar factory. Now in case of a cooperative sugar factory, your gross receipts or turnover in the previous year is more than 50 crore rupees. Now such cooperative sugar factory paying interest to its member or it paying interest to another cooperative society. Previously, it was a blanket exemption, but effective Finance Act 2020, now there is a restriction. Now, such cooperative society whose gross receipt in the preceding year exceed 50 crore rupees, then for this type of cooperative societies, say for example, I told you a cooperative sugar factory, for them, this exemption is not available. For them, interest paid by such sugar factory to its member or interest paid by such cooperative sugar factory to any other cooperative society is liable to deduction, and then that exemption has been gone by. Now I am here explaining you. Yes, I can take you through this all. Now the question comes to here, this was that 194A33 interest paid by a cooperative bank to, or rather interest paid to any cooperative society engaged in carrying on the business of the banking. For example, I am on this issue that I have taken a loan. I am a businessman and my turnover is say 50 crore rupees, and I have taken a loan from a cooperative society, cooperative Path Samstha, and I am paying interest to cooperative Path Samstha. Now, otherwise, I am required to do the TDS on all other payments. So therefore, I am also paying interest to cooperative Path Samstha. Whether such interest which is paid by me to cooperative Path Samstha is also liable to TDS. The plain answer seems to be yes, but the dispute is with regard to this wording, that whether cooperative Pata Samstha can be a cooperative society engaged in carrying on the business of banking. Now, what is the definition of business of banking? You know all this: business of banking, acceptance of deposits from public, and lending and accepting of deposit, and withdrawal by check, draft, order, or otherwise. This we can see, but the wording highlighted is from the public. Now here, whether the cooperative Pata Samsthas can be considered to be carrying on the business of banking, the answer is definitely no. The answer is definitely no, and so is the Bombay High Court in Nagpur, Bombay High Court Nagpur in Buldana Urban Bank. In fact, here the scenario was different. Buldana Urban Cooperative Credit Society, income tax department took a stand that you are engaged in business of banking, and therefore you are not eligible for ATP2 because of ATP24. Here the Buldana Urban Cooperative Credit Society argued that we are not in the business of banking, because definition of business of banking is much wider than what we do. We are only in the business of accepting, providing credit facilities to its members, and we are allowed to accept deposit only for members. We are allowed to lend only to members, and therefore that is not banking. We are not allowed to use the word bank, and Nagpur bench of the Bombay High Court held so, and it was rightly held that they are not engaged in carrying on the business of banking. So cooperative Pata Samsthas cannot be said to be engaged in the business of banking. So also Bombay High Court in Panji bench, KPM Cooperative Credit Society. Now this KPM Cooperative Credit Society has been referred to the Supreme Court, and the matter is pending before the Supreme Court. But the department has approached the Supreme Court on this particular issue, but the decision is yet to come. And discussing all that it is an undisputed that the transaction with non-members are insignificant and minuscule, and therefore on the above basis it cannot be concluded that the appellant's principal business is of accepting deposit from public, and therefore it is in banking business. It is not accepted. They are not in banking business. Now typically when one studies and when looks at the other decisions, now these are the decision in context of deductions of ATP. Bombay High Court Panjim bench in KPM and Bombay High Court Nagpur bench in Buldana Urban. These are typically decisions in favor of the assessees when the assessees deduction under section ATP 2A1 was tried to be denied, applying the provisions of ATP 24, and the High Court has held in favor of the Cooperative Credit Society in these two cases. But we have a decision just for our information, particularly in the case of Maharashtra Arogya Mandal. Now here what happened, Maharashtra Arogya Mandal is a charitable trust. It was required to make investment under section 11(5) for accumulated funds. Now 11(5) allows you investment in a bank, cooperative bank, but it does not allow you investment in a cooperative credit society. So if you make investment with respect to accumulated funds under section 11(5) with a cooperative credit society, will that be an eligible investment under section 11(5)? Department had taken a view in case of Maharashtra Arogya Mandal that it's not one of the prescribed investment under section 11(5), and therefore the benefit should not be allowed of accumulation. Pune ITT in this case held that Pata Samstha or Cooperative Credit Society is just like a bank. Their function is almost similar to banking, and therefore, even if the investment is in the Cooperative Credit Society of Pata Samstha, benefit of accumulation should not be denied because the the investment is in terms of, can be said to be in terms of or in accordance with section 11(5). So therefore, in terms of section 11(5), investment of accumulation, this was held so. That's what I was telling you, that in case of KPM society, that presently the matter is before the Supreme Court, particularly with respect to applicability of section ATP4 versus ATP2A1. SLP has been admitted in case of KPM Cooperative Credit Society and many other cases. And argument on behalf of the revenue is that since also did that non-members, they are engaged. Citizens Cooperative Credit Society, we have seen that decision which was totally against the cooperative society. And in case of Citizens Cooperative Credit Society, the society's majority of the business was with non-members. And kind of argument that they are in money laundering or whatever fishy thing that were talked about that of that cooperative credit society, Citizens Cooperative Credit Society. The Supreme Court denied deduction under Section 80P to A1 to the society. And based on this, now the arguments keep coming, and we are waiting for this issue to be decided by the Supreme Court, particularly in such cases where argument is being made by the department that the cooperative credit societies are also in the business of doing banking, because they are at times deal with non-members or nominal members, and we are waiting for the decisions. Now, this is implication. Actually, we have seen this. This is also seen. I can take you further amendments. So this is 194A amendment at a glance. One can see this, and one can refer to this slide as to the deciding the deductibility, that 50 crore rupees limit. I was talking about 194A3, small Roman 3 and small Roman 5. Those exemptions which are there for cooperative society paying interest to members and paying interest to other cooperative society. If the gross receipt exceed 50 crore rupees, then that exemption is withdrawn. Now here you have this. With respect to cooperative banks, TDS paid to members is still applicable, but TDS paid by, interest paid by cooperative bank to other cooperative societies, if the gross receipts of the cooperative societies is less than, cooperative bank is less than 50 crore rupees. Let me repeat this. A cooperative bank with gross receipts of less than 50 crore rupees, and a cooperative credit society is having deposits with that cooperative bank, then it is interest paid by one cooperative society to another cooperative society. It is not interest paid by a cooperative bank to its member. It is interest paid by a cooperative bank as a cooperative society to another cooperative society. So in my opinion, cooperative bank paying interest, cooperative bank with gross receipts in the preceding year less than 50 crore rupees or up to 50, does not cross 50 crore rupees, and it pays any interest to any other cooperative society, cooperative credit society, then that interest paid is not liable to TDS. One can take that. Can Patsanstha give Form 15G to deductor cooperative banks to avoid TDS? Section 197A1B. If you refer for 15G, then it applies to all as types of SSC other than partnership firms and private and companies. Firms and companies, it does not apply. It applies to all other categories of SSC. So it applies to even AOP, which is the status of the cooperative society. But the problem is, you give an undertaking that your income does not exceed the basic exemption limit that you have before allowing your gross total. It talks about the gross total income and doesn't talk about the total income. So this is a slightly typically a litigated area. Some people claim that still 15G can be given by cooperative banks, but I hold the opinion that because of specific provisions of section 197(1)(b), these are the provisions I fear, and the highlighted word are the provisions of section 197(1)(b) shall not apply to whom, where income credited or paid or likely to be credited or paid during the previous year in which such income is to be included exceeds the maximum amount which is not chargeable to income tax. Now, exceeds the maximum amount not chargeable to income tax. We have seen in case of cooperative credit society, the tax structure 0 to 10,000, 10%. That means there is no basic exemption like 2,50,000, which is applicable to individuals. So in my opinion, 15G proposition is not available with respect to cooperative banks. It can be available to any other types of cooperative societies, not to cooperative banks. TDS in respect of nominal members, Bombay High Court in Jalgaon District Cooperative Bank has struck down the CBDT circular. CBDT had issued a circular that nominal members, they do not have voting rights, and therefore TDS provision under section 194A will be applicable to cooperative banks. that time it was an exemption available to all, even member studies was not applicable. But department tried to say that when we have withdrawn the exemption for members, it also applies to nominal members. Now, in the case of this Jalgaon District Cooperative Bank, Bombay High Court struck off the circular of the CBDT saying that and the main definition of member has to be taken as defined as per the Cooperative Acts, and the Cooperative Act takes into account all types of members, including associate and nominal members, and therefore exemption which is available to members should also apply to nominal members. You cannot exclude nominal members from that. Cooperative banks and business reorganization 44DB is a specific section, and these things can be allowed to the successor. What is available to predecessor can be available to the successor. Then balance eligible period under this section to be reckoned as if there is no merger or demerger, and there is specific section for allowing you to carry forward losses of the predecessor bank, section 72AB. If the conditions as prescribed under section 72AB are fulfilled, then accordingly you are eligible to carry forward the losses of the predecessor bank by the successor bank. Now I am taking you to the taxation issues of the cooperative credit societies, that is Pat Samstha, which are large in number with us, and therefore I am taking you to the precautions while filing the income tax return, because you and me in large numbers we are seeing that CPC while processing the returns of cooperative Pat Samstha is making adjustment by disallowing the deduction claim under section 80P, and substantial amount of infructuous demands are getting created in the processing under section 153, 143(1)(a). So why these demands, infructuous demand keep arising, and what are the precautions that one needs to take while filing the return under while filing the ITR file, and wherever you are claiming deduction under section 80P, then I'm presenting in the slide as to the status that one must select. Main status has to be AOP BOI, and sub status has to be other cooperative society. You look here, society register, when it is AOP BOI, then sub status are this. Here, this is other cooperative society. You say cooperative bank, you will not get the deduction. But you have to be very careful. Primary agriculture credit society, you are not. Pat Samstha is not. You are other cooperative society, and therefore you have to choose only other cooperative as your sub status. That precaution you have to take while filing ITR file. That is one. Next is all cooperative bank to opt for 115 BAD. I discussed in the beginning, because you become eligible for 22% tax rate, that is effective 25.168 as against 31.2% or 34.9%. Form 10 IF has to be filed on or the before for filing the due date. And you, as I told you earlier, this option once exercised cannot be withdrawn subsequently. And if you choose this 115 BAD, then you lose the deduction under chapter 6A, additional depreciation, etc. And therefore you have to be very clear. I'm repeating, I have the slides for repeating, just to caution all the users, all the listeners, that only in case of such cooperative societies like cooperative banks, where there is no specific exemption under section 180P to 80P, only in those cases one has to go for 115 BAD. So here is the particular clause in your ITR 5. Are you opting for new tax regime under section 115 BAD? So while filing the return of a cooperative Pat Samstha or cooperative credit society, cooperative milk society, primary milk society, where you are eligible for deduction under section 80P, then you have to say no. Are you opting for new tax regime? You have to say no here. By mistake, in a hurry, if you click yes, then you have it. You will be in a lot of problem. You will not get deduction under chapter 6A, that means the ATP you will not get. CPC will process your return without giving you chapter 6A deduction, means ATP deduction, and there will be huge demand. So be careful while ticking this yes or no. In case of banks, you have to tick this yes. In case of cooperative Pat Samstha, you have to take no. Be careful on that. And Once that is, if you say yes, then it asks the acknowledgement number of Form 10 IF filed by you, and accordingly you can proceed. Now, this is section 80P, deduction 80P. There is a separate schedule in ITR 5 so far as deduction under section 80P. Now, what this schedule requires you to fill? It requires you to fill what is the business, nature of business code, income and amount of eligible deduction. And here you have to fill in the requisite category, ATP 2A1, ATP 2A2. Just now we discussed all these sections, ATP 2AE, 2A for others, 2D, 2C, 50,000 or 1 lakh rupees and all that. What is important, what I wanted to highlight here is the nature of business code. What business code that you must give? Now, look here. This is the portion of the instructions to ITR 5, which I'm presenting before you in this slide. And the yellow highlighted portion with respect to deduction ATP is that what the instruction to ITR says that then respective business code should be selected in both nature of business and schedule ATP. Now look here, this is part A general. Part A general. Here you have to give the nature of business that you give for individual, HUF, and everybody who is having income from business or profession. You have to select the code here, trade name, whatever your business name, and description, what you are dealing in. So here you have to give the business code. Here also you have to give the business code. This is schedule ATP, and this is schedule part A general nature of business. Now what CPC does is it compares the code, business code given here with the code here in this column. And if this nature of business code does not match with this code, then you are not given ATP. And therefore you have to be very clear that whatever code you give here is what is the code appearing here. For example, these are the codes. Business banking or credit facilities to its member 23001. So if you are giving 23001 here, you must give 23001 here, right? Then cottage energy 23002. You have to give 23002 here and also 23002 here in the second column. So you have to be very clear as to the code that you give, and accordingly, if these schedules part A general, nature of business, and ATP schedule, if these are properly filled in with proper business codes, then there should not be any problem in getting the deduction. Now, sometimes I have seen these are the subsequent codes which you can see. These are all codes given according to ATP2 structure. So you choose the proper code and claim. Now, interest and dividend from investment and other code 23011. So it has to be 23011 in both the places. So accordingly, you have to claim. If it is not there, you don't claim it. And then finally, from schedule ATP, here it comes that deduction ATP here. Again, chapter 6, this is another schedule 6A, which is the combined schedule for all types of deduction under chapter 6A. Now, from ATP, that amount has to come here. It automatically comes, but sometimes it may not come due to software bug. You have to clearly see that it has come in both the schedules. You have to see, it is your responsibility that it comes in this schedule, also in this schedule. This is chapter 6A schedule and this is ATP schedule. It has to come in both the schedule. Then if you take care of all this, then probably you will be done, and there will not be any adjustment by the CPC denying you deduction under chapter 6A. Particularly in case of Patha Samsthas, we see huge demands. That is why I have been elaborate with respect to this. Now, next issue with regard to ATP is one of the mandatory requirement as per the amended section 80C, which is applicable or effective from AY 1819, that such deduction will be available to you only if the return is filed on or before the due date under section 139(1). Right from 1819, this has been an issue, and the issue is if there is a delay in filing the return on account of some reasonable cause, will it still be applicable? Because there is no concept of reasonable cause with respect to section 80 AC. It is a clear cut that for getting deduction under chapter 6A, deduction in respect of certain incomes, That is in respect of ATP with respect to cooperative credit societies, and whatever we discussed about ATP 2A1, 2A, ATP 2A, 2B, 2C, 2D, 2E, and 2F. These are the direction with respect to certain incomes, and accordingly, to get this deduction, one of the mandatory requirement is to file the return before the due date of filing the return under section 139(1). And in case of cooperative societies, by default, the date is 31st of October, and last date was extended to 7th of November. So filing the return before the due date of filing the return is a mandatory requirement. But is there a scenario that there is a reasonable cost, something very serious has happened, there is a fire, the record is destroyed, and whatever? So whether there is a concept of reasonable cost, the answer is no. Can the delay be condoned? Yes. There is one scenario that people have to file petition before the principal commissioner or the jurisdictional commissioner for condoning the delay in filing the return under section 119(2)(b). And once you file the return, once you get the delayed condone, probably you will be eligible to claim the deduction under section ATP, even with respect to the returns which are filed delayed. But remember, 119(2)(b) is very specific. It covers only certain situations where you will be eligible to get the delay condone. For example, if there is no refund, by claiming deduction under section ATP, you are not eligible for any refund, then you are not losing any money. In such case, there is no authority even with the principal CIT to entertain your application under section 119(2)(b). So there has to be some refund eligible, and since you are losing that refund, you are applying for 119(2)(b), and then the principal CIT will be well within its jurisdiction to allow you the condonation of delay. Now the question is whether the denial of ATP is within the scope of 143(1)(a). Now here are the situations here are the adjustment which can be made by CPC while processing deduction, while processing your return under section 143(1). Now, any arithmetical errors in the return, disallowance of loss claimed in the rear, which is set up of depreciation, then disallowance of expenditure or increase in income is recently added, indicated in the audit report. Disallowance of expenditure or increase in income indicated in the audit report. Unabsorbed depreciation, unabsorbed losses in respect of returns which are filed beyond the specified date in earlier years, and 26A, 16A or 16 in any income reflected there, that is authority. But clause 2, incorrect claim, if such incorrect claim is apparent from any information in the return, and disallowance of deduction allowed, disallowance of deduction claimed under section 10 AA, ATIA, ATIB, ATIB, ATIC, ATID or ATIE. There is no mention of section ATAC. There is no mention of section ATP. Or nor the word is that entire income, entire deduction of chapter 6A. So what I mean to say is that the deduction denial by CPC, can it fall under clause 5? The answer is clear no, because of the specific restricted scope. Can it fall under clause 2? Probably yes, and that is how that is how the CPC is making the deduction denial in the processing of the return. Possibly yes, incorrect claim based on the information available in the return, because available information in the return is that you have filed the return beyond the due date, and therefore it's an incorrect claim. ATP not allowed to you. Now, this has again been a litigated area, and Mumbai ITIT and New Ideal Cooperative Housing Society said that no, the scope of 143A is not large enough to allow the CPC to make the disallowance of such deduction in 143A processing. But Delhi ITIT in 5 engineers also held in favor of the SSE. Again, the things that I was discussing, that it doesn't fall within the scope of the CPC. Because basically the argument and accepted argument is that 139(1) words used in ATSE have to be read with section 139(4) and not essentially with one. So 139(4) time limit also return file should be eligible to claim the deduction under section 180P. ATAC will not come in way is what Delhi IT in 5 field engineer said, but there is a Madras High Court decision in Veerappa Malayam Primary Agricultural Cooperative Society, and here in the writ, Madras High Court has categorically held that such adjustment by CPC is well within the scope of section 143(1)A, and therefore disallowance denial of deduction is very well within its right. So therefore, the scenario that now re-emerges is that the only option with respect to deduction of ATP for delayed filing of return is to file an application under section 19(2)B before the jurisdictional commissioner and to get the delay condoned. And if you are able to get the delay condoned by the principal CIT, probably you will be able to continue to claim the deduction of chapter 6A. Okay. Here, thereafter, we now come to this highly litigated issue about interest received by cooperative societies from cooperative banks. Totgers we are talking about. I am on a very specific issue because this itself can be a separate topic for discussion for 2-3 hours. Now, what I am trying to tell you is with respect to interest received by a cooperative credit society from other cooperative banks. Should one claim the deduction in respect of such interest from cooperative banks? Should it be claimed under section ATP 2A1? Or should it be claimed under section ATP 2D? Because if you claim the deduction under section ATP 2D as interest or dividend received from other cooperative society, then it becomes income from other sources. So you admit it as income from other sources. But you claim that that interest along with the interest received from members from financing giving loans under section ATP 2A1, then you claim this as income from business. Pune ITAT starting with NIFAD Nagari Sahkari Patra Samstha, interest from nationalized bank, from mutual funds, gains on mutual fund, all treated to be income from business. So, and this has been consistently followed. So far, it is not overruled. It has been subsequently followed many other decisions. So it is typically, see, basically the argument is that why a cooperative Pata Samstha or a cooperative credit society is required to keep funds with a cooperative bank. Say for a district cooperative bank, it reserve fund, where will it come? Reserve fund has to be invested with the district central cooperative bank. Or to maintain the CD ratio, maintain the SLR as mandated by the cooperative department of the government of Maharashtra, that the investment has to be made with cooperative banks having audit classification A. So A class audit cooperative banks, these cooperative samstha can invest, and they are investing to maintain the mandatory requirement of the SLR in their case as mandated by the cooperative department of the government of Maharashtra. So when this is a mandate, this is my business requirement. Accordingly, I'm investing. Accordingly, I'm keeping the reserve fund with the district central cooperative bank. So therefore, this is my business requirement, and therefore, such interest which is received by a cooperative credit society from any cooperative bank or a district central cooperative bank is income from business and not income from other sources. It's not Totgers. NIFAD Sahkari Patra Samstha, Pune ITAT has distinguished the decision of Totgers of the Supreme Court, where because Totgers was a sales society, cooperative sales society. What was the business of the Totgers? Totgers business is that they were facilitating selling of the agricultural produce of their members. So when there is no season, there is no requirement of payment of any funds to the farmer members of that society. So they had surplus funds. Such surplus funds not being utilized for the purpose of business, they were invested, and from that Totgar Society, Totgar Sales Society was earning income, and Totgar Sales Society in the beginning claimed that it is their business income, which Supreme Court ultimately said that it cannot be your business income, it has to be income from other sources. And if it is income from other sources, you are not eligible for such, you are not eligible for deduction under section 80p2A1 on such interest earned by the, because it is out of the surplus fund investment. And when it is out of surplus and investment, business, it's not your business, it is income from other sources. Now, what happened subsequently, Supreme Court held so. But there is one aspect in the Supreme Court decision which nobody is bothering to look at. Now, when you say that it is income from other sources, then there was an also without prejudice or alternate argument by the Totgar's Cooperative Sales Society that whatever expenditure that we have incurred for earning such income, on which we are not allowed deduction under section 80p2A1 because you treat this as income from other sources, then proportionate deductions of other expenses should be allowed to us. And that matter has been restored by the Supreme Court to the files of the High Court to consider this issue of the allowable of the proportion deduction, which so far has not been taken further in any of the cases, because largely the matter has been disposed of or deciding the issue of deductibility deduction under section 80p full. The issue of proportionate deduction has never come up in any of the decisions. Now, this Totgar again came up for again in their case in the subsequent years, looking at the decision of the Supreme Court, 80p2A1 is not allowed. So Supreme Court, because Supreme Court stated that this is the income taxable under other sources and not PGBP. So in the subsequent year, say for example in AY 1213, Totgar said that, okay, this is not our business income. It is income from other sources, we accept. But now this interest we have received from other cooperative societies or cooperative banks. And therefore we are eligible for deduction under section 80p2D, if not under section 80p2A1. Now, Totgar Cooperative Sales Society was before the Karnataka High Court from AY, I think 6-7 to AY 12-13 together. 6-7 years were before the Karnataka High Court together. Karnataka High Court first took up the AY 12-13, and in its decision of 5th January 2017, it held in favor of the Totgar Cooperative Society. It said that yes, we agree with your argument that if it is income from other sources, still, since it is received from a cooperative bank, which are first cooperative societies, and interest and dividend received from cooperative societies eligible for deduction under section 80p2D, therefore, you are allowed this deduction. So, 5th January 2017, AY 12-13, Karnataka High Court in the very same Totgar's Cooperative Sales Society holds this issue in favor of it. But in the subsequent year, in the subsequent decision, which was given by the Karnataka High Court itself, in other years, one earlier year and subsequent 5 years, earlier and subsequent 5 assessment years, in the same Totgar Cooperative Sales Society's case, in its decision of 16th June 2017, it overrules its own decision of 5th January 2017, and it says that no, we don't agree with this argument, and cooperative banks is a different species in itself. It is not cooperative society, any other cooperative society. It is a cooperative bank, and particularly in view of 80p2-4, which bars deduction under section 80p for cooperative banks cannot be considered to be other cooperative societies, and therefore Karnataka High Court holds that in its decision of 16 June 2017 that cooperative banks are not the species of cooperative societies, and therefore interest received from cooperative banks by other cooperative societies is not eligible for deduction under section 80p2D. C and AG took the objection with regard to the department not following the decision of the Karnataka High Court of 16 June 2017, and therefore we see all the litigation now in case of various cooperative societies. Very recently, we know that in many of the cooperative credit societies cases, even the principal CIT, jurisdictional principal CIT, has issued 263 notices with regard to the assessment completed in case of cooperative Pathasamsthas, where they have been allowed deduction under section 80P, not following the decision of Karnataka High Court, but following many other decisions like NIFA, Nagri Sahakari Pathasamstha, and many other decisions of the jurisdictional Pune ITAT. But still, department not accepting that decision of the jurisdictional Pune ITAT issued 263 notices. Now here I am giving you in this slide as to what is the reasoning of the Karnataka High Court in its 16th June 2017 decision, holding that cooperative banks are not the species of cooperative cooperative societies, and therefore interest received from cooperative banks is not eligible for deduction under section 80P. These slides will be available to you, but it is suffice to say that Karnataka High Court not in favor of the cooperative societies. But what are the arguments and what are the decisions? Mavila Service Cooperative Bank, then you have Tumkur Merchants Savarda Credits, again by the Karnataka High Court. Mavila is by the Supreme Court, and Sant Motiram Mahara Sahakari Pathasamstha, Pune ITAT, this not following Tumkur, not following Todgar, but following Tumkur of same Karnataka High Court holds that ATP 2A1. In fact, Tumkur is Sant Motiram is basically on ATP 2A1. But very recently, this is again analysis by Mavilai. I will not go much into that. But very recently, in if I remember it, Sharad Nagri Sahakari Pathasamstha Vita and Pragati Gramin Nagari Sahakari Pathasamstha. Pragati Nagri actually is a very latest decision, I think of December or January, where a bunch of cooperative credit societies, in whose case section 263 notices were issued, which were challenged before the Pune ITAT, and Pune ITAT has again reiterated its stand in that decision that interest received by cooperative Pathasamstha from any other cooperative bank is eligible for deduction under section ATP 2A1 and ATP 2D. They continue to hold this stand, not agreeing with the decision of the Karnataka High Court in the Todgar. So that is how the litigation is, and that is how the matter stands today, and we continue to litigate that. Citizens Cooperative Society, I told you in short that basically they were dealing with mainly with non-members. You can see most of the deposits were from the second category member, that is nominal members, and they were used to give the loans to the first category. And it was found, as a matter of fact, that the depositors' borrowers were quite distinct in reality, and therefore the Supreme Court has gone against in this case, and they gave decision against the society. But Pune ITAT, just to tell you, bring you the facts in front of you regarding the latest position with regard to Citizens Cooperative Society. ATP 2A1 held that Pune ITAT, in the case of Prerna Gramin, held that facts of the case in Citizen Cooperative Society are not applicable in Maharashtra, and this decision of Prerna Gramin also has been followed by the Pune ITAT in many Supreme Court, many of its subsequent decisions, and therefore Citizens Cooperative Credit Society Supreme Court, that decision is not really that problematic. That still doesn't remain that problematic for all of us. ATP is still available, having so citizens having been distinguished by the Pune ITAT itself in Prerna Gramin and subsequent decisions. Now, the final part of my today's deliberation is what are the amendments made with respect to the cooperative sector in the Finance Bill 2023. We discussed about 115 BAD specifically for the cooperative society, which was parallel to 115 BAA with respect to the companies. Now there is 115 BAB for companies, which is there again coming about 2-3 years before, which gives the one of the lowest corporate tax rate of 15%. Again, here 10% surcharge applies, and 4% education sales applies, and accordingly will be the rate. But the point is that that 115 BAB was available only for companies, and this year's budget, as I told you in the beginning, gives substantial impetus to the cooperative sector. And one of the most important amendment that has been made with respect to cooperative sector in this budget is the introduction of this 115 BAE, giving this is the most concessional rate of 15% for the cooperative sector. Now the conditions are that it should be incorporated on or after 1st April 23. Manufacturing should start after on or before 31st March 2024. Though memorandum, notes on clauses mention the dates of 31st March 2025. Actually, the finance bill specifies the date of 31st March 2024. Probably this will be clarified by the security at an appropriate time. But according to me, it is 31st March 2024. One can really understand that the time gap given for any cooperative society to avail this benefit is just 1 year's open window, that is from 1st April 2023 to 31st March 2024. You have to incorporate, you have to set up, you have to commence manufacturing. All that will happen, that in the manufacturing sector. In cooperative sector, cooperative means manufacturing. Say you want to start a sugar factory, lot of licensing from many departments that you need to obtain. So all these things, compliance becomes very cumbersome and difficult, time taking. One really doubts whether it is at all possible for a sector like cooperative sugar to actually get incorporated and start manufacturing by 31st March 2024. We hope that this date will get extended as has been happened with 115 BAB with companies. It kept on increasing, and finally the commencement date, sunset date, is 31st March 2024, even for the companies, new companies. So the date should get extended even for the cooperative societies, but that you must be engaged in manufacture or production of any article or thing, and research in relation to or distribution of such article or thing manufactured or produced by it. Then splitting up second-hand machinery, unless it is imported machinery, second-hand machinery up to 20% is allowed. Splitting up, reconstruction, that formation is not allowed. Those all conditions are common, which are there for 115 BAB. They are common here for 115 BAE. Rather, I would make a statement that if you compare 115 BAB versus 115 BAE, the word companies in 115 BAB stands replaced by the word by the word society, cooperative societies. So what is there for company is there for cooperative societies. Except section 115 BAE as proposed is exact replica of 115 BAB for companies. Now here you see that you have to avail this option, must be exercised this option on or before specified under section 139(1) for furnishing first return of income in the prescribed manner. Please note this, first return of income. And once exercised, you cannot withdraw it. Then you will not be able to claim certain exemptions. You will not be allowed set off or carry forward of loss, which is because of this specific deductions. You will not be able to claim additional depreciation, 20% additional depreciation. Surcharge 10% will apply. Then safeguard is introduced that you cannot shift profits, artificial hike in profit to get the advantage of reduced tax rate of 15%. There is a safeguard introduced, and MUT provisions will not be applicable to you. That is with respect to 115 BAE with regard to the cooperative manufacturing newly set up cooperative societies. Now 115(19) is a very, very welcome amendment which is proposed in this budget, which relates exclusive to the cooperative sugar factories. One of the highly litigated issues with regard to cooperative factories has been the sugarcane purchase price. Now, typically, the mechanism of giving the last or final installment or the determination of final cane price in case of cooperative sugar factories, particularly in our South Maharashtra area, is that the final installment is decided after taking into account various factors. In that season, whatever expenditure incurred, what is your extraction rate, what is the expenditure incurred, and then considering all these actual results are considered, and then the final sugar cane price is determined, and then accordingly the final installment is given to the sugarcane growers, sugarcane suppliers by the cooperative society. Because of this particular mechanism of determination of the final sugarcane price, it has been the argument of the department that this way of determination of final sugarcane price doesn't actually is a charge on your profit, it actually is a distribution or appropriation of profit, and therefore we don't allow you this deduction. It has been the argument on behalf of the cooperative sugar factories that it is only the mechanism of determination of the final cane price, and so long as it is not about the price fixed by the government for the sugarcane purchase, though it is above the statutory minimum price, still it should be allowed the deduction because it is charge on profit. It is not distribution of profit, or it is not something which is paid in lieu of profit. Effective AY 1617, a specific clause in section 36(1) was introduced, which said that purchase price paid up to the price fixed by the or with the approval of the government will be allowed as a deduction. The question was with regard to the deduction claimed and the litigation happening or litigation taking place with all earlier years. Now, this is what is sought to be settled by this introduction of clause 19 or subsection 19 to section 155. Now, one of the simplest way of settling down the dispute has been brought in by way of rectification mechanism. As per the proposed 155(19), the society has to file a rectification application for claiming deduction of this disallowed portion of the sugarcane purchase price, so long as it does not exceed the price fixed by the government or with the approval of the government. This application has to be filed within 4 years, and the period of 4 years as per section 154(7) will be recognized up to 31st March 2017. So all this litigations to stand end altogether, and finally there should be what I silence about in the legal corridors. Finally, there should be silence about this particular issue, which is one of the highly litigated issues. I know cases have been pending in all legal forums. Very recently, about a year back, Supreme Court sent all such cases back to the files of the AO. Now you can imagine the plight of the AO and the litigation which the cooperative sugar factories has to undergo. Again, then AO, then CIT appeals, then tribunal, then High Court, and then again Supreme Court, because the directions were not that clear. So there are, I would call it a kind of chaos particularly in respect of this issue being discussed. So therefore, finally, a good thing that silence about this thing settled. Very welcome state by the government. And this is another third one in line, that in respect of primary agricultural credit society and respect of primary cooperative agriculture and rural development bank, these are the two types of society which are also excluded from ATP 2.4, if you remember. And these are the societies, cooperative categories of societies which have been given this relaxation, that section 2 section SS and T, acceptance on loans and deposits and repayment of loans or deposit other than by account paid check or account paid draft or any other banking channel. That limit which came in from 1st April to 1989, 20,000 rupees, that still remains 20,000 rupees for all other categories. But now from this year, as proposed by the budget, that limit stands extended to 2 lakh rupees only for these two types of categories of societies: any deposit accepted or repaid by, and any loan taken or repaid from to. So a loan taken by me, if I repay it to this type of societies, or a deposit given to them and repaid back by them up to 2 lakh rupees, will not be subjected to penalty under section 271D or 271E because of the breach of section 269 SS and 269 T, because now the enhanced limit of 2 lakhs would apply in respect of these societies. So far as section 194N is concerned, I just discussed that limit of 1 crore rupees for the deductive cooperative societies, it has been enhanced to rupees 3 crore rupees. That I discussed at the time of section 194N itself. I suppose with this, I come to the end of today's deliberations, and now I stop here and would like to take any questions if there are any, and then we can stop here. Before I stop, I thank the Pune branch for giving me this opportunity to be present before about 150 members who are taking up this direct tax course and listening to me in continuous manner. I've been seeing at the participant attending, and the number has been always about 140 plus. Thank you so much for patient hearing, and thank you Pune branch for the opportunity given to me. Thank you so much.
Thank you, sir, so much for this session. Before the thanking note, I would like to take up some question answers.
Yes. Can I go to the chat box or question answers?
The Q&A section, sir.
Yes, Q&A. Voice is breaking. Cooperative housing, there is one, Mr. Bhupendra Harshi, he has a question. Cooperative Housing Society filed ITR 5 before due date. Deduction under section ATP2D properly claimed in original ITR, but it is disallowed by CPC in 143(1) intimation, and they have shown tax demand. We filed rectification, but it is also not accepted, and demand is still shown in rectification order. What is to be done? Do we need to file appeal? In fact, I have dealt with this issue in detail as to what and where the business code is to be mentioned. If you have claimed a deduction under section ATP2D, please check your ITR that you have mentioned this code of 23011 in your nature of business, and ATP schedule you have mentioned 23011 with respect to that ATP2D. So nature of business has to be mentioned one. Then of course you check your status as AOP, BOI and substatus as any other cooperative society. So once you have to check status, substatus, then business code and the deduction appearing in this ATP. And if this is necessary, then wherever rectification required, you can rectify your JSON file and accordingly once again file the rectification application. And if still the CPC is not accepting, then it would be a proper course for you to file an appeal against the rectification rejection. Ensure that your appeal is filed within 30 days from the rejection of the rectification application, so that your appeal will not be considered to be having filed after the due date. Another aspect I would want to tell you is that ITR 5 we are filing. When we are filing ITR 5 and you are claiming ATP2D, that means you have income in the form of interest and dividend. And in your not trading account, in your profit and loss account in ITR, against the interest and dividend columns, this figure has to come. So this is another aspect that you have to ensure. So one, I told you about the status and substatus. Second, I told you about schedule ATP and schedule chapter 6A. Then I told you about schedule part A general, where you have to see the business code. And lastly, I'm telling you, when you are filling ITR profit and loss account, not trading account, in profit and loss account, there is interest and deduction, interest and dividend column. Against that column, you must have mentioned this. So all these things are matching properly. There is no question that you will not be disallowed this deduction. Still, then you have to file the appeal. There is no other option. In case of yeah, this is there is one more question from Mr. Sunil Shetty. We have a Sunil Shetty here. In case of cooperative housing society, shall we offer income from cooperative banks under business or other sources? I tell you, it is income from business. Sorry, income from other. I'm sorry. It has to be income from other sources, not because here cooperative housing society. Can it be your business? Simply no. It has to be income from other sources. I told this that it has to be income from business for cooperative Patta Samsa, because there is a mandate of keeping SLR, and because SLR you have to, our reserve fund has to be invested with the district central cooperative bank. So it is a mandate of the business, and therefore it is income from business. But for cooperative housing society, it has to be income from other sources. And just I discussed before for the question of Mr. Vipendra Harshe, you have to accordingly show it all, taking all precautions while filing the return. Then I take up the next question from Mr. Uday Patil. In case of a housing cooperative society required to fill balance sheet and profit and loss account ITR, or should declare only interest in other sources? Yes, I answer this. Yes, correct. Swati Kulkarni, whether interest received by National Bank is allowed under section 80P 2A1? The answer is yes, according to me. You can refer beneficially to the decision of Pune ITT in case of NAFED, Nagri Sahkari Path Samstha. It is allowed under section 80P 2A1, no issues. Then, sir, if this question is of Srinivas Gundeli, if interest received on deposit with cooperative bank is more than total taxable income of cooperative credit society, should we claim deduction under section 80P2A1 or 80P2D? In case of cooperative credit society, you should still claim deduction under section 80P2A1. Now, please remember this, that if interest from cooperative bank is more than the gross income of the or the total income, suppose your income received from cooperative banks is 50 lakh rupees and your total income is 40 lakh rupees. Now you are claiming deduction under section 80P, that deduction will be limited to the total income, that is 40 lakh rupees. So versus your interest received from cooperative banks, your income is only, total income is 40 lakh rupees, your deduction is limited to 40 lakh rupees. Now, should you claim this deduction under section 80P2A1 or 80P2D? My submission is that it should be claimed under section 80P2A1 only, because first you take a stand that it is income from business. Now, suppose that stand is not accepted, then you can fall back on this without prejudice stand that it is income from, if you treat this as not income from business, and if you consider this as income from other sources, then allow me deduction under section 80P2D. So 80P2A1, you have an alternative stand to take, which will be without prejudice to your stand that it is first business income. If not treated as business income, it should go to income from other sources. But if you on your own say that it is your income from other sources, then it will be difficult for you to again come back and say that it is income from business and not income from other sources, because you yourself would be claiming it as income from other sources by claiming it as deductible under section 80P2D. So take it under 80P2A1, not allowed, then go to 80P2D. Alternate stand. And when you claim 80P2A1, please remember that while filing the ITR in your profit and loss account, this interest from cooperative banks should be shown as in the trading account, should be income from services as a main income and not in profit and loss account. This interest from cooperative banks which is received should be not shown in profit and loss account, it will be shown in the ITR in the trading account where sale of services or any other main income, any other income of main source. In that category, you must show this. Then you will not get the denial of deduction even by the CPC in processing. All right. So this was the last question. I suppose there is one more. Sir, if you are not filed return on, if we have not filed return on, there is any relief available? No, you cannot claim the deduction without claiming it through the return. So not filing the return will be devastating for you. You will lose the deduction altogether. If you non-due date 139(1), even though CN claim deduction under section, we can claim. No, you cannot. No, that's what I discussed under section 80AC. I was discussing elaborately the 80AC, and therefore you will lose the deduction. Yes, that's what I discussed. Yes.
Sir, in the chat corner, we have one question from Satyam Agarwal.
Can you read it? Yeah.
They say, sir, CPC is disallowing interest claimed under 80P2D. This is with respect to interest earned by cooperative housing societies from cooperative banks. Kindly guide on steps to be taken.
We have taken this issue. We just discussed that.
Yes.
I advise you once again that take proper care as discussed while filing the return. There is no question that CPC will disallow that. Try this by rectification. You will get that. No problem.
One more question from Kalpesh Joshi, sir. In case of BDDR provisions in cooperative banks, if available provisions at the beginning of year is greater than whatever required during the year, can 8.5% of profit BDDR provision deducted shall be claimed even if there is available opening reserve?
No, that's what is the litigation and Pune ITT holding against the cooperative banks, that unless and until you make of provision by debit to profit and loss account, you are not eligible to that deduction, whether it is out of 8.5% of the total income or out of 10% of the aggregate average rural advances. Either 8.5% of total income or 10% of the aggregate average of rural advances combined together will be subjected or restricted to the amount debited to the profit and loss account under BDDR. If there is no debit, then you will not get the deduction as the matter stands today. Yeah.
There's one more question from Swati Kulkarni, whether interest received from nationalized banks are allowed as deduction under section 80P2A1. AOs are disallowing the same and many litigations are pending.
That's fine. I told you, you can rely on Pune IT decision, Nifant Nagri Sakari Samstha long back. Even you can rely in very recent decision of Pradhati Gramin. It talks about ATP2A1 also and ATP2D. So either you can rely on that. Litigation is there. What to do? Litigation is there because department is going by the audit objection by C and AG. C and AG has stated that why is the department not following the favorable decision of Karnataka High Court in Todgers? So department by and large is going by Todgers because there is no jurisdictional High Court decision as of now available from the Bombay High Court. Sooner or later it will come, and then I think the entire controversy will set to rest. But for the time being, we have this litigation at our hand, and many of the CITs are accepting it at NFSC. Some of the CITs are not accepting an NFSC, but the tribunal by and large, there is not a single decision which has come against the SSC. Pune IT is holding in favor of the SSCs. Yeah.
Okay. Just last two questions, sir.
Yeah.
Second last question from Bharat Parmar. Interest on earmarked funds are capitalized, whether taxable under income tax in case of housing society.
Yes, it is taxable in the case of housing society, even if they are earmarked funds. The receipt is of revenue nature, and therefore it is taxable in the hands of the mutuality concept in case of cooperative housing society with respect to such interest received, or even on the earmarked funds. It's not mutuality concept will not apply, but interest received on such earmarked funds, even if it is capitalized, still according to me is not a capital receipt, it's a revenue receipt and will be taxable in the hands of the cooperative society.
Okay. Just the last question from CA Riaz Patel. Can we file income tax return for financial year 2020 to 21 in updated return? And if we file it, can ATP deduction be allowed?
Answer is no. Unfortunately, the answer is no, because it is 139 one time limit. That's what section 80 AC talks about, and doesn't talk about the extended time limit of even 139.4 or 139.8A. Not a question. Not allowed.
Okay, sir. So I think we have answered all the questions, and I would like to thank you, present a vote of thanks to you, sir, because it was a very interactive sessions. We could see the number of questions being asked, and the coverage was also good. Like we could not even think of that these all sections are also linked to the cooperative society, and the recent litigations and applicable decisions are also being discussed. So it was clearly a good coverage, and we are immensely thankful for such a great session, sir. Thank you so much.
Somebody is asking my number, contact number. Somebody is asking my contact number.
Yes.
I can.
And sir, the many of the participants are requesting for the presentation also.
Presentation is already there with Pune branch. Freely.
Yes. So we'll upload it on the website, Pune
yes,
website.
No copyrights. No copyrights. No copyrights.
Thank you, sir. Thank you.
My number also you can share 98220 10247. I can type it here. 98220 10247 is my number, and host and panelist. So you can host and panelist. I can send this. Can it go? I'm trying.
Yes.
Has it gone?
No, not yet.
I'm not able to send this. Yes, gone.
Yes.
Yes.
Okay, now you can, those who can, who want to, interact, no problem.
So the presentation will be uploaded on the Pune website portal.
Yeah, no problem. Again, email ID. I'll give this is my email ID. I can't see the number. You can give the number if anybody wants it. I can't see the number. People are not able to see the number. You can take down my number 98220-10247. I repeat 98220-10247. Yes, Deepali has given this. You can check this. Yes. All right, we can stop now. I think we're done.
Yes, thank you so much, sir.
Thank you so much, sir.
Thank you. Thank you so much, Pune branch. Thank you so much. Thank you, Pranav sir.
Thank you. Thank you so much, sir.
Bye. Yes, Philip. Yeah.
Thank you, participants, for joining. Now we officially sign off.
Thank you.